In yesterday's commentary, we talked about rolling recessions and what does that mean for the markets. Today, let's talk about the ongoing bull market trend. Here's what you need to know before the bell. So yesterday we discussed this idea of rolling recessions, and that was allowing the markets to absorb some of these financial hits that were kind of coming along from either the Russia-Ukraine war, bank crises, the Fed hiking interest rates. And these events have occurred in a time frame where the market takes the hit, consolidates that, then rallies on expectations that things may improve, then another crisis hits. Again, simple reset process. And we've been seeing this over the course of the last year as markets declined. But it's important to make sure that we always focus on what the markets are doing versus what the headlines and the media and podcasts and all this are saying is going to happen. Prognostications are great, but markets tend to do the opposite of what everybody thinks is going to happen. And this has been really the case this past year. Markets declined to that 200-week moving average over the last really 4 or 5 weeks now. We've climbed solidly back above this 40-week moving average. Now, here's the important thing about these moving averages. First of all, the 200-week moving average has been really the defining trend of this bull market really since the 2008-2009 financial crisis. Once markets climbed above that 200-week moving average, it has stayed above that for this entire time, just the exception of a very brief break below that moving average back in 2020, but that was very quickly recovered and the markets maintained their bullish trend. Secondly is that the difference between a bull market and a bear market has really been defined by the 40-week moving average. Now, this is that shorter term moving average, but when the markets are above that 40-week moving average, the markets tend to remain positive for a period of time, particularly when that moving average is sloping upwards. Bear markets tend to occur like in 2015, 2016, when you had that kind of rolling bear market over a course of about 6 months. The markets traded below that 40-week moving average. But again, this was a correction because we never violated that 200-week moving average that defines the overall bullish trend of the markets. And those have remained, and that's been a key indicator, of course, for this market really over the last 12 years. But this really goes back further. Even if we go all the way back to the 1999, 2000 run up to the dot-com crisis, we see the market trading regularly above that 40-week moving average, staying above the 200-week. The bear markets were defined when the markets crossed below that 200-week moving average and traded both below the 200-week moving average and the 40-week. So what defines the bull markets versus bear markets is whether or not markets are trading above these short and long-term moving averages. And right now, at least technically, the market remains in a bullish trend. The bullish trend is positive. Markets are moving higher, and we are now trading back above the 40-week moving average, suggesting higher prices are coming over the course of this year. That's hard to believe because of all this negative data and sentiment that we have out there, but we need to pay attention to what the market is saying and evaluate that relative to what our views are so we can manage the risk in our portfolios appropriately. I'm your host, Lance Roberts, and that's what you need to know before the bell.